Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello everyone, my name's Manpreet and welcome to Through the Noise. Is there too much optimism out there? That's the question that's top of our minds as we're looking at financial markets today. We've obviously come out of a great US earnings season, but some investor positioning indicators are starting to flash short-term warning signs. How should investors be positioning their portfolios against that backdrop? To help discuss that and more, today I'm happy to be joined by Raymond Cheng, who's our CIO for North Asia. So welcome, Raymond. Clearly an interesting juncture in equity markets. We've had the positivity from the AI and strong earnings cycle, but of course uncertainty from Middle East, new US tariff threats, and of course those big upcoming IPOs. In that environment, in your view, how should investors be positioning their portfolios?
Sure, Manpreet. Global equity scaled record highs last week, despite renewed Middle East tensions and U.S. proposal to impose 10% to 12.5% tariffs against its trade partners. Now, the AI supercycle continues to drive risk appetite as the consensus lifts AI capex assumptions and AI-related price targets. Now, our AI capex upgrade in April was a measure 5 to 10 percentage points amid concerns, including funding constraints. Now, we are seeing the latest surge in debt issuances and IPOs, as well as execution bottlenecks around power and infrastructure. We remain long-term bullish on the AI supercycle, but are turning short-term cautious, given extremely stretched investor positioning raises the risk of a 5 to 10% pullback. We prefer the equal-weighted global equity index in the near term and diversification in the tech sector from AI enablers such as semiconductors and hardware to AI adopters such as internet and software. The next key catalyst will likely be the outcome of U.S.-Iran talks, U.S. payrolls, and U.S. inflation print next week. Another month of strong payrolls and an acceleration in inflation will likely shift the stance of more Fed policymakers from broadly neutral to hawkish. But no belief the job market's resilience, real disposable incomes are falling, and the savings rate in the U.S. has dropped below 3%. Close to the lowest in history. This signals stress among U.S. households amid rising energy costs. With these conflicting pressures, we expect the Fed to still stay on hold for now. Another key factor that could strain near-term liquidity would be the three mega upcoming trillion-dollar IPO deals, SpaceX, OpenAI, and Anthropic, that are expected to reshape index rates and market liquidity. Index providers are fast-tracking inclusion rules. Near-term liquidity impact is estimated at around 140 to 280 billion US dollars. This argues for reducing concentration risk within equities and bracing for volatility. As for fixed income, US government bonds face tensions between firm economic data and crowded short positioning. We continue to avoid duration risk in bonds, prefer 5 to 7 year maturities in our bond allocations, and hedge inflation risks with inflation-protected bonds.
Thanks, Raymond. There's quite a few key topics to unpack there. So let's start maybe just with a deeper dive on those big IPOs you just mentioned. I mean, what do you see as the key implications for equity markets?
Yeah, while these mega IPO deals reinforce the long-term growth thesis of AI, the Russell and Nasdaq indexes are fast-tracking inclusion rules, which could result in forced allocations by passive funds out of existing megatech names into these IPO names. The decision by the S&P index not to fast-track for now, hopefully, will moderate the impact somewhat. The other important risk to think about is with the tightening liquidity environment, these mega IPO deals are intensifying the funding challenges. Therefore, we recommend reducing U.S. tech concentration risk and broadening equity exposures.
So, on that broadening exposure trade, what are, I guess, in your view, the key drivers of that? And when you say broaden, which are the areas which you're looking at as interesting for investors at this stage?
Hmm. While we are structurally positive on AI, right, we have turned more cautious in the near term, as we talked about, as U.S. equity positioning is quite stretched at over 1.75 standard deviation above mean. Historically, such stretch position levels would suggest drawdown of close to 10% in the S&P 500 index in the next 3 months. Now, also, AI capex estimates continue to grow aggressively at a time when AI funding concerns become a bigger challenge. Therefore, we advocate broader equity portfolio diversification. Within tech, we suggest taking profit on semiconductors and rotating into internet and software names. Also, broadly across sectors, we recommend the MSCI World Equal Weight Opportunistic Idea as an implementation to diversify into other under-owned sectors such as industrials, financials, and consumer staples.
Okay, let's broaden the conversation a little bit. Over in Europe, we've got accelerating, improvement in some of the data prints, and of course, we have the key ECB meeting that's also coming up next week. I guess what are your expectations from that policy meeting? And I guess related question is, what's your view on the euro?
Hmm. First off, we reiterate our belief that the ECB will deliver a 25 basis point insurance hike in the upcoming week and then pause. Now, euro area inflation did accelerate further in May with the headline inflation print rising to 3.2%. The broadening price pressures strengthen the case for a June ECB hike, but continue negative economic surprise index readings, a contracting purchasing managers index PMI, and declining industrial production since the Middle East conflict all point to weaker growth signals in the region and softer medium-term inflation expectations. Now, all this argues against a rapid follow-up hike by the ECB. The risk to one hike and pause stance is a prolonged Hormuz Strait closure beyond weeks, which could spike energy prices. Now, against this backdrop, any euro strength is likely countered by persistent US dollar resilience. Recent US labor data has reinforced expectations of a Fed on hold. Now, since mid-May, the euro against US dollar has traded in a tight range, with volatility at the lowest since year 2020. Near-term direction will likely hinge upon upcoming US data, including next week's consumer inflation data from the US, as well as the US-Iran developments. Technically, we expect the euro remains mildly bearish against the US dollar, below key moving averages, but the 1.160 level support should hold firm.
All right, and finally, just staying with the ECB as well, they also published a report recently that argued gold has overtaken U.S. government bonds as the world's largest reserve asset. I mean, does that impact your view on staying overweight gold in any way?
Now, data from the ECB and the World Gold Council shows that by end of year 2025, gold indeed became a global central bank's top reserve asset, accounting for around 27% of total central bank's reserves. That's ahead of the US government bonds positioning at around 22%. This shows a long argued central bank structural demand for gold remains intact, especially amid geopolitical fragmentation, sanction risks, and U.S. fiscal outlook concerns. However, we believe the near-term gold price trend could be likely less linear, as this is testing the critical technical level of 4,400 US dollar per ounce, which is around the 200-day moving average. And that could risk a bridge and a potential correction towards 4,100 US dollars per ounce. Now, we would use any pullback around those levels as a long-term accumulation opportunity.
All right. Thanks, Raymond. I think we'll bring today's conversation to an end at that point. Thanks so much for taking the time to speak to our listeners today. If I can summarize the top takeaways from today's conversation, number one, we prefer broadening equity exposure, given some of the short-term positioning risks. MSCI World Equal Weight, of course, one preferred route, but even within tech, we'd broaden beyond semiconductors to internet and software. Second is within bonds to, of course, avoid excessively long bond duration. We, of course, think 5 to 7 years maturity is the sweet spot in US dollar bonds. And finally, the point on gold. Some weakness is, of course, possible, but if we do get weakness, we'd use that to accumulate. So thank you again for dialing into to this podcast. We hope you enjoyed the conversation, and we look forward to speaking with you again next week.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.